Hold on tight, because after a period of soaring highs, global markets are taking a breather, and some are even suggesting a larger correction could be on the horizon. After a period of substantial gains, particularly in gold and certain stock indices, investors are starting to lock in profits, leading to a noticeable dip in major markets. But is this just a temporary pullback, or the start of something more significant? Let's dive into the details. In Hong Kong, the Hang Seng Index began the day with a decline, opening 129 points lower, which translates to a 0.5% decrease, settling at 25,897. Over on the mainland, both the Shanghai Composite Index and the Shenzhen Component Index experienced similar downward pressure. The Shanghai Composite Index dropped by 20 points, 0.52%, to 3,896, while the Shenzhen Component Index fell by 91 points, 0.7%, to 12,985. These figures indicate a widespread trend of profit-taking across the region. But here's where it gets controversial. Geopolitical uncertainty is playing a significant role in this market retreat. The potential meeting between Chinese President Xi Jinping and U.S. President Donald Trump hangs in the balance, casting a shadow of doubt over future trade relations. Remember the recent conciliatory tones from both Washington and Beijing? Trump threw a wrench into that narrative by suggesting the meeting maybe won't happen. This ambiguity is unsettling investors and contributing to the risk-off sentiment. Is this just political posturing, or a genuine shift in diplomatic strategy? And this is the part most people miss. The dramatic overnight plunge in gold prices has become a major focal point. The price of the precious metal plummeted by over 5% on Tuesday, even without an immediately apparent trigger. It's now trading 0.6% lower at $4,098 an ounce. This is particularly noteworthy because gold has been on a phenomenal run this year, surging by over 50% due to various factors, including geopolitical and economic uncertainty, as well as expectations of interest rate cuts by the U.S. Federal Reserve. Gold is traditionally seen as a safe haven asset, and its recent volatility raises questions about the overall stability of the market. According to Tony Sycamore, a market analyst at IG, the gold market was massively stretched, massively overbought, fueled by a significant amount of FOMO, fear of missing out. He suggests that these conditions make the market vulnerable to sudden corrections or flash crashes. Sycamore also warns that other markets, such as the Nasdaq, may be experiencing similar conditions, indicating the potential for broader market instability. He describes these market movements as little tremors, hinting at the possibility of something more significant to come. Could this be the beginning of a larger market correction, or just a temporary hiccup? Across the broader Asian-Pacific region, MSCI's index, excluding Japan, was down by 0.24%. Futures trading also indicated a cautious mood, with Nasdaq futures falling by 0.2% and S&P 500 futures dipping by 0.07% after a mixed trading session on Wall Street. In Japan, the Nikkei stock average opened 64 points, 0.13%, lower at 49,252. While this aligns with the broader market trend, it's worth noting that the Nikkei has experienced strong gains recently, driven by expectations of increased fiscal stimulus under the country's new prime minister, Sanae Takaichi. Some analysts are optimistic about the potential impact of Sananomics on the Japanese equities market. Louis Chua, a research analyst at Julius Baer, believes that the Nikkei has further upside potential, supported by twin tailwinds of corporate reform and a pro-growth reflationary path with Takaichi's election. But, will this be enough to offset global downward pressure? So, what do you think? Is this just a temporary market correction, or are we heading towards a more significant downturn? Are geopolitical tensions the primary driver, or is it simply a case of overvalued assets seeking a more realistic level? Share your thoughts and predictions in the comments below.